James, how did the Harmony portfolios fare in June?
Well, as you know, June was an interesting month for investors. It started in a fairly muted fashion, following on from difficult returns in May. As the month progressed, confidence returned slightly, and while it remained a volatile month, by the end of the period, the markets were up reasonably strongly. That translates from an absolute return point of view into pretty decent returns for the majority of the Harmony range. Equities are up in the order of 5%, whereas government bonds were down ever so slightly, and so in absolute return terms we did well. The one exception to that, the Australian Dollar Balance Fund, was down in absolute return terms over the month. That's really because of the strength of the Aussie dollar over the period, up about 5% against the US dollar, for example, and where we have some global holdings in that portfolio, the translation effect of those foreign currency returns into Aussie dollars faced quite a headwind from the strength of the Aussie dollar over that period.
James, you've spoken about absolute. Can we hear about maybe relative returns?
Yeah, relative returns in June were a little tricky on the basis that the biggest return in June, 3% or 60% of the equity market's return, came on the final day of the month. Now, that gets reflected in benchmarks because there's no particular timing. The benchmarks don't close until the end of the market session. The issue for the Harmony funds, to an extent, is the fact that although it's reflected in benchmarks, we have a cut-off in the Harmony funds, which is earlier in the day, and therefore it's before some of our underlying holdings will have reflected that move up in markets. So some of our holdings have the return up to the day before, the 28th, and some of them have to the end of the month, the last business day, the 29th. As a result, a proportion of the holdings in the fund don't reflect that last day's bounce, if you like, that 3% uptick, although it will come through in the numbers in July. So we'll have a perky start to July for some of the funds, but it means that last day bounce isn't reflected, and it's a temporary thing, it's a transitory effect, but it's one that we need to bear in mind and account for when we're looking at the relative returns for June.
James, you've spoken about it being a risk-on month. What were the other main drivers of performance in June?
The main drivers of performance in June really are neutral to equity markets. Obviously, in a month where equity markets go up 5% in round numbers, the portfolios will benefit from that. The other main asset allocation position we take in the funds presently, as we've mentioned a number of times on these calls, is to be underweight government bonds on a valuation basis. US govies drifted off by about 0.4% over the month. European government bonds down by about 0.7 in local currency terms. So to be underweight assets which fall in value is clearly beneficial for performance. We were slightly underweight. In fact, as the month progressed, halfway through the month, we took out a couple of percent from our global property equity exposure. That part of the market had quite a strong month. We took 2% away from that as the markets were rallying, so that impacted relative performance slightly, but not materially. But the other major position we should talk about is the credit overweight, and investment grade outperformed government bonds slightly, but sub-investment grade high yield bonds returned around about 2% in the US over the month, so again good positive absolute returns from that overweight position, and the convertible bonds position, global convertibles returned about 2.4%, so again that explicit overweight position in convertibles was accretive to performance in June.
James, did you make any major changes to the portfolio during June?
Aside from the small reduction we made in the global property securities holding, which we initiated roughly in the middle of the month, the other small tweak we made to the positioning in the portfolio was to add between 2 and 3% in inflation-protected government paper, and we did that by reducing our nominal government exposure and taking a little bit from cash and bonds elsewhere. The rationale for that is that on a relative basis, relative to nominal government paper, the inflation-protected tranches are reasonably inexpensive still. The break-even inflation, which is the implied level of inflation priced in, is still relatively low and below levels that we expect to see going forwards. The reason that inflation is a worry, particularly for bond investors, is because in nominal bonds, cash bonds if you like, where you're paid a fixed percentage face value as a coupon, remember that as inflation goes up, the actual purchasing power that gives you will diminish through time. So inflation protected bonds, where your income is adjusted for the prevailing rate of inflation in a world where we believe inflation is presently priced quite low and will likely to surprise on the upside, is quite a potentially profitable relative value proposition for us. Finally then, just on the global property securities, which I mentioned earlier, why we cut that really was because global property securities year to date have returned between 2 and 3 times the return of the broader equity market, and we thought that that's unsustainably high return differential, and we took a bit of profit from that position, and we hold that in cash presently with a view to adding it back as the relative valuation differential between global securities and global property securities readjusts itself slightly.
Can we have some colour on the performance of the underlying managers in the funds?
Sure thing. There's 2 different effects to probably think about. The first one, coming back to my month-end NAV timing issue, holdings like Firth are certainly missing that final day at price monthly. We miss that. And also the Cohen & Steers fund, we believe that's going to tick up in performance next month, because that's around about 3% behind what we'd expected to have done. Again, roughly the last day's equity market return. The other one to bear in mind, actually, and it's not a timing issue, is the Tiburon Taipan fund. That underperformed its particular benchmark by around 5% over the month, which is very disappointing, and we've spoken to the manager at length about that. The main 2 drivers of performance were the manager moving too quickly into resources stocks, and they've not been too well looked after given people's anxieties regarding China's slowdown and the inevitable impact that would have on resource demand. And the manager is less heavily into defensives compared to others in the peer group. Something in the order of 70% of managers in that region underperformed over the month, so it's not unusual to be positioned in that way, but having said that, it's still disappointing for us. We are confident over the longer term, though, that remains a good position. It's just short-term particular quirks in the market, and particularly given what was, as you said earlier, ultimately a risk-on market. To be penalised for being overweight resources and underweight defensives is actually quite surprising.
Thank you very much, James.
Thanks, Richard.